Cash flow versus profit. Why your business can be profitable and still fail. Hey everyone, Scott Lindsay here. So look, I want to talk about something today that honestly keeps me up at night. Not for myself anymore, but because I see it happening over and over again to good people with solid businesses. And it's this idea that if you're profitable, you're fine. You know what I mean? Like profit equals success, end of story. Except here's the thing, it's not true, not even close. I've spent my career as a chief risk officer, chief compliance officer, director of internal audit, CFO of a publicly traded bank. I've worked with global financial institutions, guided boards through operational nightmares you wouldn't believe. But I've also been in the trenches myself. I founded an internet solutions company that grew to serve more than 85 financial institutions, hundreds of thousands of customers, government agencies across multiple jurisdictions. So I'm not just speaking from theory here. I've lived both sides of this. And one of the biggest, most dangerous myths in small business, it's this passion about profit over everything. Or really, it's the profit over cash flow thing. Because here's what nobody tells you when you're starting out. Your business can be profitable on paper and completely broke in reality. And that disconnect, that's what kills businesses. Now, before we go deeper, if this resonates with you, do me a favor. Hit that like button, drop a comment below telling me about your own cash flow struggles or wins, and subscribe to Small Business Risk. I put these videos together because I genuinely want to help you avoid the landmines I've seen take down otherwise great businesses. All right, let's keep going. So let me paint you a picture. You've got a company, let's say you're doing consulting work or you're manufacturing a product, doesn't really matter. End of the year comes around, your accountant says, "Congratulations, you made $100,000 in profit this year." You're thinking, amazing, right? I'm killing it. But then March rolls around. Payroll's due, your supplier needs payment, rent's due, and you're sitting there staring at your bank account going, where the hell is that 100 grand? You know what happened? Timing. The great silent killer of small businesses. See, profit is an accounting concept. It's revenue minus expenses over a period of time, usually a year, sometimes a quarter. But it doesn't tell you when the money actually shows up in your account or when you have to pay your bills. That's cash flow. And cash flow is reality. I'll give you a real example from my internet solutions days. We'd land these huge contracts with financial institutions, great margins, solid profit on paper. But here's the gotcha. We'd have to pay our developers, our infrastructure costs, our hosting fees immediately, like within 30 days, but our clients, they paid on net 60 or net 90 terms. Some of them even longer because, big institutions move slow, real slow. Ironic in that they hold big cash reserves, but notoriously take their sweet time paying their bills. Try paying them late on a car payment or mortgage, right? So we'd book this beautiful profit in January, but we wouldn't see the actual cash until April. Meanwhile, February payroll still has to get paid. March expenses still have to get covered. You see the problem? We were profitable. We were also constantly scrambling for cash. Here's what a lot of people don't get. And honestly, I didn't fully appreciate this until I was deep into my CFO role. Profit is an opinion. Now, before you think I've lost it, hear me out. When you calculate profit, you're making assumptions. You're depreciating assets over time. You're accruing revenue you haven't collected yet. You're matching expenses to the period they belong to rather than when you actually paid them. All of that is governed by accounting standards, sure, GAAP or IFRS or whatever framework you're using. But it's still built on estimates and judgments. Cash flow? Cash flow is a fact. Either the money is in your bank account or it's not. Either you can make payroll or you can't. There's no interpretation there. I remember sitting in board meetings at the bank, and we'd have these discussions about allowances for loan losses or the useful life of equipment for depreciation purposes. All legitimate accounting questions. But at the end of the day, what mattered operationally was, do we have enough cash to fund loans? Can we cover deposit withdrawals? Will we meet our regulatory capital requirements? Profit told us if we were strategically on track. Cash flow told us if we'd survive the quarter. Now, here's where the passion over profit myth becomes really dangerous. You hear it all the time, right? Follow your passion, do what you love, and the money will follow. And look, I'm not saying passion doesn't matter. It absolutely does. Passion gets you through the 80-hour weeks and the setbacks and the moments when you want to quit. But passion without understanding cash flow, that's just expensive therapy. Because what happens is people start businesses around something they love, baking, coaching, design work, whatever, and they price based on what feels fair or what they'd pay, not what the business actually needs to survive. Or they reinvest every dollar back into making the product better, the experience more amazing, the brand more beautiful. All noble things, but all potentially fatal. I've seen bakeries with lines out the door go under. Why? Because they were selling croissants for $3 when their actual cost, including labor, rent allocation, ingredient waste, was $2.75. Yeah, they were passionate. Yeah, customers loved them. But the math didn't math. It just didn't work. And even worse, they'd get a big catering order, $5,000 worth of pastries for a corporate event. Sounds great, right? Except they had to buy all the ingredients up front, pay their staff overtime to produce everything, and the client paid net 30. So they spent $3,500 in cash today to eventually make $1,500 next month. If they didn't have that $3,500 sitting around, they literally couldn't afford to take the profitable order. That's the cash flow trap, and it's especially brutal for service businesses and anyone dealing with inventory. Let me get a little technical for a second, but I'll keep it grounded. There's this concept in finance called the cash conversion cycle. Basically, it measures how long it takes for a dollar you spend to come back to you as cash. For a product business, it starts when you pay for inventory. Then you hold that inventory for some number of days. Then you sell it, but often on credit, so you're waiting for the customer to pay you. The whole cycle from cash out to cash back in might be 90 days, 120 days, sometimes longer. During that entire period, you're funding operations with what? Either cash reserves, a line of credit, or increasingly desperate measures. Service businesses have it a bit easier because there's no inventory, but you've still got the receivables problem. You do the work today, invoice the client, wait 30 or 60 or 90 days to get paid. Meanwhile, you're paying your team every 2 weeks, like clockwork. When I was running my internet company, I became obsessed with this cycle. We'd track average days to collect. We'd incentivize early payments with small discounts. We'd have really uncomfortable conversations with clients who were slow paying. Not because we were greedy, but because literally we needed that cash to keep operating. And here's something I learned the hard way. Growth makes this worse, not better. You'd think as you grow, you'd have more cash. Nope. As you grow, you need more inventory. You have more receivables outstanding. You have higher payroll. Your cash needs grow faster than your revenue. I've seen profitable, fast-growing companies go bankrupt purely because they couldn't fund their own growth. It's called overtrading in finance circles. Growing yourself to death. Sounds ridiculous until it happens to you. So what's the alternative? How do you actually survive this? Well, first thing, and this sounds obvious, but I promise you, most small business owners don't do it. You have to forecast your cash flow, not just track it after the fact, but forecast it. Look ahead 13 weeks minimum, ideally 26 weeks. When are your big payments due? When are you expecting customer payments to hit? What's your historical collection pattern? Do customers usually pay on time? Or does net 30 really mean net 45 in practice? Are there seasonal patterns? Tax payments coming up? Equipment purchases? Map all of that out. Then you can see the gaps coming before they become emergencies. At the bank, we had entire teams doing cash flow forecasting daily, not because we were paranoid, but because with billions in deposits that could theoretically walk out the door, we needed to know exactly where we stood. Small businesses don't need that level of sophistication, but the principle is the same. No surprises. Second thing, and this is crucial, manage your payables and receivables actively. That means being strategic about when you pay bills. Now, I'm not saying stiff your vendors or damage relationships, but if you've got net 30 terms, you don't have to pay on day 10 unless there's a discount or strategic reason. Use your full payment window. On the flip side, collect aggressively, invoice immediately, follow up on late payments promptly, offer early payment discounts if it makes sense. Some businesses offer 2% discount for payment within 10 days versus net 30. Seems expensive, but if that 2% is cheaper than the interest on the line of credit you'd need to cover the gap, it's actually a smart move. Third, and this is where my risk management background comes in, build a cash buffer. I know, easier said than done when you're just starting out, but honestly, I'd rather see a business with $50,000 in the bank and $40,000 in profit than one with zero cash and $60,000 in profit. That cash buffer is your shock absorber. Customer pays late? You're fine. Unexpected equipment repair? You're fine. Economic downturn and sales dip for a couple months? You can weather it. The rule of thumb I usually recommend is 3 to 6 months of operating expenses in reserve. That's your sleep at night money. And yeah, it means you're not maximizing returns or growth in the short term, but you're buying something way more valuable, survival. And hey, if you're finding this valuable, if I'm saying things that make you think differently about your business, this is a good time to hit subscribe and turn on notifications. I release these videos to share what I've learned the hard way so you don't have to. Also, comment below. What's your biggest cash flow challenge right now? Is it collecting from customers, managing inventory, funding growth? I read every comment, and sometimes your questions become the next video topic. Let me tell you about a mistake I made early on. Classic entrepreneur move. We landed a huge contract, game-changing size for where we were at the time. And I got so excited about the revenue, the growth, the validation, that I didn't run the cash flow numbers carefully enough. We needed to hire developers immediately to deliver on the timeline, needed to upgrade infrastructure, needed to bring on support staff. All of that was cash out the door in months 1 and 2. The contract payments were milestone-based, but the first major milestone wasn't until month 4. You see where this is going, right? We scrambled. We made it work, brought in a small bridge loan. I personally guaranteed some vendor payments, a couple of sleepless nights. We delivered, we got paid, everything turned out fine, but it was closer than it should have been, and it was entirely preventable if I'd just thought through the cash timing instead of getting swept up in the excitement. That's when I learned. The opportunity that kills you looks exactly like the opportunity that makes you. The difference is whether you can fund the gap. Basically, I neglected to practice what I preach. Lesson learned and reinforced. Now let's flip this around. What are the actual risks of focusing on profit and ignoring cash flow? First and most obvious, you run out of money. Seems simple, but it's shockingly common. Profitable companies fail because they literally can't make payroll or pay their suppliers. And once you miss payroll or default on obligations, your reputation tanks, your team leaves, your suppliers cut you off. Game over. Second risk, and this one's more subtle, you make bad strategic decisions. If you're only looking at profit, you might take on low-margin, slow-paying customers because, hey, revenue is revenue. But if those customers tie up your cash for 90 days, they might actually be destroying value even though they're technically profitable. I've seen companies turn down fast-paying, slightly lower margin work in favor of higher margin work that pays slow. Looks great on the P&L, destroys cash flow. They would have been better off taking the lower margin and keeping cash moving. Third risk, you lose negotiating power. When you're cash-strapped, you make desperate decisions. You take loans with terrible terms. You offer huge discounts to get paid faster. You can't invest in opportunities that pop up. You're operating from a position of weakness. I remember at the bank, we could always tell which businesses were cash constrained versus which ones were managing well. The constrained ones would agree to almost anything to get a loan approved. The well-managed ones had options, could negotiate, could walk away if terms weren't right. Fourth, and this is the one that really gets me, you miss the warning signs. Profit can be a lagging indicator. You can be profitable for months while your cash position quietly deteriorates. By the time you realize you have a problem, you're already in crisis mode. Cash flow is a leading indicator. It tells you in real time whether your business model is actually sustainable, whether your growth is healthy, whether you're in trouble. Here's something else worth thinking about. The relationship between profit and cash flow changes depending on your business model. If you're a SaaS company, software as a service, You might have customers paying you annually upfront. Great cash flow, but you're recognizing that revenue over 12 months for accounting purposes. So you might have amazing cash flow and relatively modest profit. If you're doing big project work, construction, consulting, whatever, you might have the opposite. Huge profit margins on paper, but all the costs upfront and payment at the end. Terrible cash flow even though you're profitable. Neither is inherently good or bad, but you have to understand which situation you're in and manage accordingly. At my internet company, we eventually shifted from annual billing on internet access accounts to more recurring or monthly revenue models, partly for this reason. Monthly payments are so much easier to manage from a cash flow perspective than big annual contracts with payment at the end. We took a slight hit on margins to offer flexible payment terms, but our cash predictability improved dramatically. You know what else nobody talks about? The psychological toll of cash flow stress. I've been there. Lying awake at 3 a.m. doing mental math, wondering if that big receivable will clear before the payroll processor hits your account. Putting personal expenses on hold to make sure the business has enough cushion. That knot in your stomach every time you check your bank balance. It's not sustainable, and it clouds your judgment. When I was dealing with that in my own business, I made decisions out of fear rather than strategy. I'd take any client who could pay immediately, even if they were a bad fit or a distraction from our core business. I'd delay investments we needed because I was hoarding cash. Once we got our cash flow under control, built that buffer, improved our collections process, negotiated better payment terms, everything changed, not just financially, but mentally. I could think long-term again. I could be strategic. I could sleep. That's the thing about cash flow versus profit. Profit is about whether you're building value. Cash flow is about whether you're going to survive long enough to realize that value. Let me ground this in something concrete. Say you're starting a business, any business. You've got two choices in how to structure things. Option A, higher margins, slower payments. You make 40% profit on each sale, but customers pay net 90. Option B, lower margins, faster payments. You make 25% profit on each sale, but customers pay net 15. Which is better? Most people instinctively say option A. Higher margins, more profit, obviously better, right? Wrong. Well, maybe wrong. It depends entirely on your cash position. If you're cash constrained, and most small businesses are, option B might actually be better. You're turning cash faster, which means you can reinvest faster, pay bills easier, grow more sustainably. Yes, your profit margin is lower, but your cash conversion cycle is so much better that you might actually end up wealthier, faster. This is why Amazon famously operated at razor-thin margins for years. They weren't chasing profit, they were optimizing cash flow. Customers paid them immediately. They paid suppliers on 60 or 90-day terms, and they used that gap to fund growth. Brilliant from a cash perspective, even though profit margins were minimal. Now, I'm not saying you should run your small business like Amazon, but the principle matters. Sometimes the lower profit option is actually the better business decision when you factor in cash flow. All right, here's the truth that ties this all together. You need both. You can't just optimize for cash flow and ignore profitability, because eventually you need to actually make money. And you can't optimize for profit and ignore cash flow, because you'll run out of runway before you get there. The sweet spot is understanding the relationship between the two and managing both actively. In my various CFO and CRO roles, I'd look at both every single week. How's our profit tracking against forecast? Great. How's our cash position? Where will we be in 30, 60, 90 days? What are the risks? What are the opportunities? For small business owners, you might not need that level of rigor, but you need something. Monthly at minimum. Look at both your P&L and your cash flow statement. Understand the drivers of each. Know when the gaps are coming and plan accordingly. And here's the thing about the passion myth that really bothers me. It sets people up for failure and then blames them for it. You start a business doing something you love. You pour your heart into it, you make sacrifices, and when it fails, not because you weren't good at your craft or passionate about the work, but because you couldn't make the cash flow math work, you're left feeling like you failed, like you weren't good enough, passionate enough, committed enough. But that's garbage. You didn't fail because of lack of passion. You failed because nobody taught you that passion doesn't pay bills. Cash pays bills. I've met incredibly talented people, artists, bakers, coaches, consultants, who could have built amazing businesses if someone had just sat them down and explained, here's how cash flow works, here's why it matters, here's how to manage it. Instead, they got told to follow their dreams and figure it out. That's not advice, that's negligence. So look, if there's one thing I want you to take from this, it's this. Profit is important, but cash flow is survival. Understand your cash conversion cycle. Forecast your cash position. Build a buffer. Manage receivables and payables actively. Don't take on growth or opportunities you can't fund. And for the love of God, don't assume that being profitable means you're safe. The businesses that survive aren't always the most profitable ones. They're the ones that can make payroll next week, and the week after that, and the week after that. They're the ones that understand the difference between accounting profits and actual cash. They're the ones that plan ahead and manage both sides of the equation. You don't need luck, you need knowledge, and now you've got it. Before I go, if this changed how you think about your business, if it gave you some clarity or a path forward, do me one last favor. Like this video, drop a comment sharing your biggest takeaway, and subscribe to Small Business Risk. I've been doing this a long time, from the boardroom to the startup trenches, and I'm here to help you avoid the mistakes I've seen tank otherwise great businesses. There's a lot more where this came from. Thanks for watching. I'm Scott Lindsay, and I'll see you in the next one.